Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
And James Eng. Hey,
Good
James.
morning, Paul.
So in the podcast today, we have John Griggs. And John is a multifamily owner. He's co-owner of a group called Presidium. They're based out of Dallas. John has owned in the past 12,000 doors. Now he's down a little bit from his 12,000. He's at 10,000. That's still pretty good, don't you think, James?
That's a great start.
And so we're going to talk a little bit about the road that John and his partner, who couldn't be here today, cross, and a little bit of his journey and how he did it. So you're in for a great show about how'd you do that. So I want to introduce everybody to John Griggs. John, this is everybody.
Good morning. Good to be here. Thanks, Paul.
I'm glad you're able to make it. In fact, we just closed the transaction that John was selling yesterday. So congratulations. We appreciate it.
Thank you. Thank you.
How many units was that property?
That was 216.
216. So is that including the 10,000 or is that a little bit?
we may be dipping a little bit.
Maybe
there.
be dipping. Well, 10,000 doors. I mean, that's quite of an achievement. And a lot of people want to kind of emulate you, be you. And so let's kind of talk a little bit about how people can be like Presidium. And if you can't be like Presidium, how can we join the Presidium team? So James, I'm going to kick it off to you.
Sure, John. Thanks for coming in today. Really, we just want to get started with how you got started in multifamily. So tell us a little bit about your background and what led you to multifamily.
Yeah, good deal. Well, thank you. So I was a unhappy lawyer in California in the early 2000s, and a good buddy of mine from law school, Cross Moceri, who's my now business partner, he and I were looking for a way to get out of the rat race of being corporate lawyers. And we poked around California, looked for different options in buying rent houses, four-plexes, et cetera. And kind of like now, the pricing was to a point where you really couldn't buy very much without a lot of money down. And at the time, we didn't really have a lot of money to put down. So we started looking outside California, and we looked in Las Vegas and we looked in Phoenix. And Phoenix was pretty attractive at that point. This was 2003, right as the housing bubble, kind of 2007, 2008 housing bubble was starting to gain steam and get kind of crazy. And so the pricing on the coast was nuts. But Phoenix offered some good value, and we were able to go in and get extremely attractive financing, which may or may not be available anymore, but at that point it was, and bought just a bunch of fourplexes in Arizona with their own money. Thought they'd be a long-term investment, operated them, kind of learned the business firsthand, renovated them, raised rents, did all the things that we've now learned to do as value-add operators. And what kind of surprised us was how quickly the market just got way ahead of itself. So in a 2-year period, the pricing doubled, and I'd like to say I predicted it, but I didn't. And but we benefited from it. So we sold everything in 2005 when pricing was getting out of control in Arizona. And at that point, we were looking for where's the next place in the country that is still growing, has a good economy, good dynamics, population growth, job growth. And the only really one of the few places was Texas. So at this point, we had kind of gotten to escape velocity where we could essentially quit our law jobs and take a risk. And we started putting together deals in Dallas. And we put together a 130 unit deal, a 200 unit deal, kind of another 300 unit deal. And just over the course of our first year and a half or so, had gotten up to about 1,000 units. And it worked out well. And then, once we had done that, back at that point, real estate was very much a hot kind of space, and debt and equity was very much readily available. So we built out to about 5,000 units by 2007. So it was a kind of a quantum leap. And then things got very difficult. We pulled back as things were getting kind of in the final stages of frothiness, and then fought through the downturn and just battled through it, tried to make $1 out of 98 cents and figured out the meaning of expense management. Right. And then, after kind of what seemed like a long period, we kind of the sun started to shine again, and we started buying again in 2012 and did the next leg up.
At what period of time did you actually leave because you were physically living in California, and
Right.
then you made a decision to move to Texas.
Right.
How many units did you have in Texas before you made the jump from California to Texas?
Yeah, it was sort of a two-step process. So I got a place here after we got to about 1,000 units, but was still going back and forth between here and San Francisco. My now wife was still in California, and we kind of had a long-distance relationship for a while and got married. And then after, we kind of amassed a larger portfolio here, she moved out in 2008.
Was it very tough to sell her on moving from San Francisco to Texas?
It was a little bit tough at first, just because she'd been kind of a city girl, grew up in New York and been in Boston, San Francisco, and Dallas. Just it's not thought of as kind of in the same vein as those types of cities. But I mean, I couldn't have picked a better time to make the move, because it's just the city has been absolutely just incredibly dynamic since we moved here, and now we have 2 little kids and have just a great life with our family and everything else that we've built here. It's been a great place to be.
So let me take you back to that first deal or second deal. Any lessons learned in that deal that you still remember, or anything about those transactions? Because a lot of our guys are trying to go from 0 to 1, and so that's the big hurdle for them. Do you remember anything on those transactions that stick out or that you can share with our audience?
Yeah, I mean, I guess the one piece of advice I'd have is to find a really good finance group that can really give you the lowdown on exactly what kind of debt you're going to have, because it's just a totally different game in going from the single family four-plex 1 to 4 unit kind of Freddie Fannie single family market to multifamily, and the underwriting's totally different. So partnering with an experienced finance group like Old Capital would be.
Thank you, John.
So would be something I'd highly recommend, because it's not an easy thing to understand, and like a lot of things, as they get more complicated, there's no handbook out there that tells you sort of how to do it, and it changes constantly. So it's important to kind of have someone that's in your corner giving you guidance and knows the current landscape.
Sure. And then in terms of when you're looking at your first multifamily, any sort of class A, B, or C that you really focused in on, and how you made that determination?
Yeah, I mean, we, like a lot of guys, we started out kind of in the B to C space, and just because that's where the most yield is. And if you're willing to roll up your sleeves and really get in there and put in some sweat equity, you can achieve a lot. We kind of migrated up a little bit to kind of B plus, A minus, and even doing some development now. But we still find that if you have a good operation, if you have good staffing and diligent processes, I think there's more money to be made in kind of the B and C space.
So when you came from Phoenix, sold everything, it sounds like you self-managed all your assets in Phoenix. When you came to Texas, living in San Francisco, did you start out of the gate self-managing, or did you roll in with a third-party company to manage your assets?
We started with a third-party company here, which it'd be very hard not to. I mean, just because there's so much to learn about how to, it's not necessarily rocket science, but getting the accounting set up, getting kind of the staffing set up, it's hard to do. When you're doing everything for the first time, that's one thing that would ease your transition into getting bigger projects. So,
how long ago did you decide to transition away from third party to set up your own company to self-manage?
Kind of in the 2006, 2007 period, we had gotten to about 2,500, 3,000 units as we were sort of cresting then. And it just made sense. We had kind of learned enough about or thought we had learned enough about how to do it. And at that point, a lot of people ask, so what is the break point where it makes sense? And I mean, probably in the 3,000 unit range. If you can kind of get a regional manager, get some accounting staff, it makes perfect sense. And the funny thing about it is it's not, the fees are helpful, but it's certainly not how you get rich in this business. But it's really all about control and just having that direct chain of command down to from the on-site staff all the way to, you as the operator.
Got it. So you obviously self-managed then if you took it over in 2006 through the downturn. So
right.
you were squarely in the middle of it. So that's what I think one of the things we've been trying to talk about lately, and a lot of the conversations we have. I mean, we've been in the upcycle for the better part of 5 years, maybe a little bit longer now. So I think a lot of the people that have been in the business just kind of in this upcycle haven't really fully experienced some of the things that I did and Paul did and James did as bankers back through the last recession. And some tough lessons. So you referenced some expense management. So maybe some of the things that you saw that really kind of saved your skin on a lot of these assets. Maybe you can kind of talk a little bit more in depth about one of the two of the things that you had to do to kind of stretch that dollar, and some of the tough lessons you learned back in 2008, 2009. And I think really probably my observation on about you, but 2010 was probably the worst year as an apartment operator.
Yeah.
So it took a little while for everything to kind of flush through the system and hit the tenants on the property. So maybe, I don't know if you have some general thoughts about that subject.
There's a few things on the front end that I'd recommend. I mean, the kind of enemy of success in that time is really overleverage. So if you kind of can go in with a reasonable amount of leverage that's, where there is a nice cushion on your debt service, where you're not kind of walking in already kind of struggling, that's helpful. Now, fortunately now, I mean, banks don't really let you do that. Back then they did. I mean, they would allow you to finance based on sort of.
Did you have like 85, 90% leverage on some of your deals back?
We kind of got close to that, but never got kind of quite there. But
so what do you recommend, or what are you guys doing? I mean, you bought 2 deals in North Dallas. What kind of leverage did you put on those deals when you financed them on the acquisition?
We did 75% loan to cost, which is not low leverage per se, but it's reasonable. And that's sort of building in the cost of the renovation plus the purchase price and kind of seeing where that.
So besides not over leveraging, what were some of the other things kind of just like operationally that you found were helpful or detriment to your success?
Yeah, I mean, I guess one thing in retrospect, and we learned this along the way and acted on it fortunately, but is, in a declining market, you don't want to be the last guy to kind of change your rent structure and your concession structure, because you'll suffer. I mean, basically, if you kind of stay ahead, if rents are dropping a little bit, if people are offering some concessions, unfortunately, you have to meet the market. And we saw some people that were kind of stubborn about that and just thought, look, I need to get the same rent tomorrow as I got yesterday. That's not really working in a down market. And part of it's just knowledge about what your competitors are doing and kind of staying in touch with them and doing that. And I guess the other thing I'd say is that kind of one of the reasons that we kind of survived that period and did kind of well on the backside is just maintaining the quality of your assets is important. You see folks that sort of let things deteriorate and let kind of deferred maintenance creep in. That's a tough cycle to get out of. And part of that, again, is going in with enough firepower and enough cash reserves that you'll be able to maintain the quality of your asset.
Tell me a little bit about your conversations, whether they were difficult or not with the equity. Your investors during that period of time, you may have not been paying a rate of return on their investment, your investment. How tough was it to have conversations with them, and how did you set the table correctly if we're going to return to profitability at some period of time?
Those were definitely difficult conversations. I mean, there was a fairly large group of folks, because the economy was so racked by the crisis. A lot of people really got it that, listen, we're trying to kind of hang on here. We're not going to be distributing at the 12% cash yield. Most people did. But some people were just kind of thought, look, this is, the apartments always throw off cash. And, that unfortunately, sometimes it's not true. Now, obviously they do, and it's just a matter of kind of education and saying, look, this is kind of where here are the numbers.
With that as a backdrop, how do you, when you're looking at new deals this year, anything that in terms of underwriting or when you're looking at transactions, anything about a property or location that people should keep in mind when they're looking at new acquisitions if we're, pretty deep into this upcycle?
Yeah, I mean, the one thing I'd say is that the renovate and improvement model really works. And it certainly works in a place like multiple markets in Texas, where there is kind of a terrific economy, people looking to move up in the quality of their units. One thing I would definitely caution people on is you want to make sure the neighborhood can support those improvements, and just know that even if you can find a comp or two that where it works, that's pretty important. And again, now lenders are going to make you do that, so it's not. There's some good checks on that, but it's important to be somewhat discriminating about where you do the improvements. And you can do improvements anywhere, but not every submarket supports granite countertops and kind of full-on office renovations and that kind of thing. You can still make money with providing a good, clean product.
So I know what you generally buy today is kind of North Dallas, some of the better suburban markets in Dallas, and you do a bunch of stuff in Austin as well. Back pre-recession, did you guys buy in some tougher locations and learn lessons that way too, or have we always been kind of in similar geographical areas?
We didn't go into any, what I would call kind of C- or D areas, but we did a fair amount of stuff in suburban locations, which, I found in the in the downturn got hit a little bit harder. But back then, the dynamic that you had then that you didn't have now was construction everywhere. I mean, when we had a bunch of kind of B-class apartments in North Arlington, 80s build. And we were legitimately worried that someone would come in and put up a brand new product and, basically charge 10 cents more per foot and kind of undercut us on quality. That's not really happening now because the cost of construction is just driving people to only look at kind of A locations for new construction, and they have to charge a pretty hefty amount of rent. So that is one nice thing now that we're not, the margin between our kind of B plus product and the brand new Class A's, it's so much that it's hard to imagine them kind of undercutting so much that they would compete with us.
Yeah, I think in Arlington right now, there's maybe one student deal that's going up near UT Arlington. That's it. In terms of development, so how are you guys handling that? I know you said you have one development that is getting started in Austin. How are you guys, compensating for the construction costs and then sort of the 2-year window to get it developed and then leased up?
Yeah, I mean, I would say, getting started in development is almost as hard as kind of going from that small multifamily to 100 plus unit. It's a very steep learning curve, and it takes time, it takes capital, it takes patience, and good site selection and just kind of intuitive ideas about where you should go. So it's a process. It's definitely.
So why jump into development now? How did you guys get comfortable? I guess from it sounds like for the past 10 plus years you've been in the B, C, in place, renovate, rent, and now move into the development side. What were sort of the triggers to get you guys there?
Yeah, essentially it's a bigger game as far as kind of the value of the projects and how much equity is involved, and obviously that there's potential for even greater returns when you're dealing with kind of dollars in that volume. So that's attractive. And we also got to a point where no one's perfect. I wouldn't say we perfected it, but we got to a pretty good level of proficiency with renovations and upgrading apartments that we were interested in moving to the next stage, which is ground up. And I would say this to anybody thinking about doing ground up. One thing that we've done is mitigate our risk of being a first-time developer by having, the best architects, the best contractors, spending kind of time to make sure we did that.
Having the best people on your team, and you guys didn't go with high leverage in that deal. You did a bank loan on the new development, but also probably the biggest thing is location.
Absolutely.
And how good is your location on your property down in Austin?
That's a huge factor, obviously. And if you're going to be pro-forming, we are in Austin, which is $2 rents, you have to have support for that. And obviously the lenders and equity are going to make sure there's support for that. So we found a terrific parcel in the East Riverside corridor, which we have about 1,200 units there, which have done spectacularly well as that neighborhood's changed. We had a good parcel of dirt that we bought a few years ago. And in the interim, Oracle announced that they're building what's now probably 1 million square foot campus about 3/4 of a mile from us. So 2,000 or 3,000 six-figure jobs, which are going to be millennial type folks. I hate using that word, but millennials, which is about as good of a renter base as you can get. So we're pretty fortunate to have had that happen, but we really thought that area was kind of the next place in Austin to develop. So we're excited.
A lot of guys look up to you in terms of inspiration and want to reach your level. Is there anybody that sort of you track or follow or have as a mentor that really helps you sort of move to the next level? Anyone that you can think of?
Anyone in the, I no particular person, but I definitely read a lot about kind of larger real estate operators and how they do things and how they structure their processes. One thing that we're cognizant of as a company is as it gets bigger, it's less about you as a prime mover and more about your company organization and having just the right policies and procedures in place and the right kind of people behind you to push things forward. So the kind of culture and values of a company become a lot more important as you get to a certain mass.
Anything, whether you read about it or saw it, anything that you've changed your mind about in sort of multifamily in the last year?
That's a tough call. It's tempting to think that we're near the end of the cycle, but I think there's a lot of reasons why we're not. And I don't necessarily think that, prices are going to double again in 4 or 5 years, but I think there's real value out there. Certainly in the successful metros of Texas and in taking some of this vast quantity of older product and renovating it. I saw one stat that of the call it 450,000 units or so that are 70s and 80s product in DFW, only 10 or 15% have been renovated. And that's
it.
Something like that. Yeah.
It seems like every deal's been.
I know. Where are they? Yeah. Send me one. But there's still a long tail for this, I think. I guess as far as something I've thought about that may or may not change, I mean, it seems like the pendulum and groupthink on interest rates kind of veers from where we were 6 months ago, which is we're never going to get out of a 1.75, treasury rate environment, and we're going to have low growth and low rates forever, to now, people thinking that we're destined to get back to a 5 handle on the 10-year. And it just seems like there's this back and forth. And I tend to think that we may be kind of in a good channel now where rates are not going to, they've had a big move up. I don't know if they'll go down. I wouldn't necessarily predict that, but I think they're implying a pretty impressive improvement in growth, which may or may not materialize. So
we sit here at the end of February as we record it 2017. Has your tactic on the debt placement and what product you choose and the length of fixing your rate changed in the last 90 days since basically the election to today? Have you guys changed anything operationally in what you're doing? Or are you pretty much doing the same type of debt and same floating or fixed rate structures that you were doing 90 days ago?
Yeah, I mean, interestingly, I think we're doing a little bit more on the floating rate side. We do both. I mean, my favorite product is sort of the 10-year fixed with the buy down to 5 or 7 years of yield maintenance. But, the gap between a going in rate on a floater and the 10-year is, the full coupon is a lot bigger than it used to be. So if you're, one of these people that's not sure that we're going to have 7 or 8 interest rate hikes over the next few years, I think there's some margin to play with there. I feel like floating rate debt is a better option than it was maybe 6 months or a year ago when that gap was a lot narrower.
So you're buying a cap on the float, or is it already?
They make you do it.
They make you do it. All right, I gotcha.
Which mitigates things too, right? It's not so bad.
What does that mean, James?
So a lot of banks will look at sort of if the interest rate raises up significantly in a short amount of time, can the property sustain the debt service coverage that it is projecting? And making sure that whether it's some lenders will make you cap at a 125, some will go down to a 1.0 debt service, and just make sure that if, let's say you're going in floating rate, all in is what, 4%, maybe 4.5%, and then they might have you buy caps at 5.5 or 6.5, and just depending on the property's projected NOI, make sure that the debt does not get too expensive that you can't cover your debt service.
So at 10,000 doors that you have right now versus 1,000 or even 100 doors, what are you thinking about these days? What's your 1 or 2 things that you see out there? 100 doors, 1,000 doors, now 10,000 doors. Maybe it keeps you up at night. Is it interest rates? Is it lack of inventory in the market itself? What keeps you up at night?
Yeah, it's hard to say. Interest rates less so. New product is definitely a concern. Not so much on the B and C stuff. I think on the A side. One thing that I think would be, obviously not good is if we actually had an economic recession, and you never know kind of what triggers that. I think hopefully leadership in Washington kind of does the right thing, and we don't kind of have any kind of dislocations that would upset the market. And then, obviously just booms get tired, and I would worry about that.
Any advice looking back maybe 10 years ago when you're first getting started? Any advice for people who are just getting started in multifamily? Maybe something that you could have told yourself 10 years ago that you know now, whether you learned that the easy way or the hard way.
Yeah, I would say, again, just when you're buying a property, always really do a deep dive on what it's going to cost to get the deal done and to get the deal where you want it to be. Because the worst thing you can do is go in underfunded. It's a lot harder to raise capital after you buy something than it is you can always give it back. So it's okay to go in with a little extra, a little bit more than you think you need.
Any deal that you learned that on, or that you want to talk about and maybe give an example? Or
There absolutely. I think we and again, because banks would let you do it. We bought some properties in kind of the B and C zone in 2006, 2007, where we just didn't have the renovation dollars there. We went in expecting that cash flow would cover that. And then when the cash flow goes away, it's hard to renovate. Now, of course, back then, renovating didn't really pay you much either because your rents aren't going up. But having that cushion is really critical.
All right.
And so key thing these days is everyone is seeking yield. And there's a difference between a yield on a Class A building and a Class, say, B building and C building, maybe value added. What's equity looking for today? I mean, what's the magic number that investors are looking to get on their money?
Yeah, I mean, we're still seeing that number kind of be in the mid to high teens. Some guys still expect 20, but I mean, mid to high teens seems to get people's attention.
IRR, right?
IRR, yeah, fully loaded. So, which, I mean, given that, the alternatives out there, certainly on the fixed income side, it always amazed me that number hasn't moved as rates have gone down so much. But that's just kind of what the risk-adjusted yield people want.
What about cash on cash? What are they looking for on these deals? Like high single digits?
Yeah, high single digit is probably pretty reasonable. And it's always that's about, in my opinion, that's if you're doing a renovation and if you're doing it right and if you're financing it right, that's probably about where you should be. You don't want to sort of overpromise on that side.
In terms of acquisitions, that we've asked this on a couple of podcasts, but are there maybe one or two things when you're looking at a property that are sort of must-haves or preferable in terms of demographics or things you look for? We always look for, people's secret sauce on here. And if you can share any insights on that in terms of what you're looking for, and then maybe some things that are sort of non-starters for you if you see it in a portfolio or property.
Yeah, no, that's a good one. I mean, there's always a balancing act as you're buying, especially we're buying some older stuff sometimes, to making sure that whatever needs to be fixed is fixable permanently. And that, if you go in and spend the dollars to replace whatever mechanicals, whatever systems need updating, you're not going to be surprised. There's not going to be systemic problems like plumbing leaks or chiller pipes that just will, over time, will really kind of make your life difficult. So doing the due diligence to make sure that you've got your arms around what needs to be replaced is important.
Nothing makes me personally madder than seeing someone paint over bad wood. Because
right.
Because you paint over the old wood siding, and then then the paint doesn't stick, and you're painting again in 2-3 years. And if you just would have hardied it, the paint job would last a decade. Right. And it's just, to paint a building is $450 to $500 a unit anymore to paint a building. So it's not a cheap thing to do. So that my personal thing that pisses me off when I see someone do that. So.
How about amenities? I mean, we're going through an amenity war from building to building. There's different amenities on a Class C property versus a B and now new development on an A. Let's start off with the A. What's something that is going to attract those six-figure income people down in Austin? What are you guys going to put together and work your way of what's working for you guys and even down to a C property?
Yeah. One thing that we've made kind of a hallmark of our organization and something that we think is the right thing to do, but it's also very economically smart, is sustainability. So I like to think we're leaders in this. Our new project in Austin is going to have kind of centralized HVAC system that will reduce electricity for HVAC, per unit by about 35%, which is pretty impressive. And in Austin, that kind of presenting a very green kind of product really is very appealing. And it's appealing kind of everywhere, but especially there. And then here, one thing that you can do is water saving devices, replace toilets, replace shower heads. Those kind of things are, while not necessarily amenities, they're things that can attract renters. If they're marketed well, people realize that your water bill can go down, and that's a variable cost, not necessarily a fixed one.
Anything in the C market that you guys are doing besides dog parks?
Dog parks, playgrounds. It's there's not a lot of reinventing the wheel in these things.
Have you done any? One of the things we're doing, the package rooms. Have you done anything like that on your older properties with the electronic lockers and?
We haven't, although it's something we're looking at because obviously that's becoming a
operational challenge.
Yeah, exactly.
I drove one of Mike's properties last Friday and walked into it, and they had their own package room. There was packages all over the frickin' place.
Yeah.
I mean, it really needs a independent package room, packaged key to get in, package code to get your package, because it is a labor intensive for somebody who walks in to try to find that person's package, whether it's Blue Apron where you have food that's been delivered. Now it's in the office, and now that person who can't get there for another 24, 48 hours, and then that person has to look for it. I mean, these package rooms, it really needs to be implemented.
Yeah, it's been something that we've been trying to roll out pretty much across the board. So it's been one of the things that we found as a major operational issue that just takes more so than the amenity it provides and the convenience it provides to the tenants. It just allows our staff to do other things that are productive versus playing, package delivery. What man or woman? I mean, it's been a challenge for sure.
Right.
Yeah. So
No
cool,
doubt.
James.
John, is there for our listeners out there, is there, the best way to reach out to you guys to either learn more about Presidium or have any questions? What's the best way for people to reach you?
Sure. I'm kind of a big email guy, so just shoot me a note. It's jgriggs, JGRIGGS at presidiumre.com, which is presidiumre.com.
All right.
James, what else is going on these days?
So we have a couple of Old Capital events coming up. So in March 8th, we have Greg Willett, who's going to come in and speak to our group. And then also April 26th, Mark Dotzauer. Both of those events are at the Grapevine Convention Center, starting about 6:30 p.m., so on a Wednesday night. And in our email, if you're on our email list, you can RSVP for those two events to get in.
And Michael?
I think one of the things we've been trying to make a big push for is get a little bit more visibility in iTunes and some of the other podcast aggregators. So if anyone enjoys the content and get guys like John in and more guys like John, kind of similar to him, give us a review and a rating. Certainly helps our rankings within iTunes and some of the other podcast aggregators.
And that now we have a 15-page white paper report about Financing 101. And then, Michael, you also have, for SPI, you guys have a checklist. Tell us a little bit about that checklist.
Yeah, so if people are interested, you can certainly email info@oldcapitallending.com, and we can get you the basic kind of multifamily financing 101 white paper. It's about 14, 15 pages long, kind of the high level on how these deals get done and what you should think about, as well as I put together kind of our sample due diligence checklist. So if you're putting an LOI out there, some of the basic things that we look for from potential sellers in the property. So kind of have our 2 or 3 page due diligence checklist that we attach to all our LOIs. I certainly don't mind giving that out as well if you ask for that at info@oldcapitallending.com.
That's great. Last question, I think, to John. I mean, again, looking back, you've done this for 10, 12 years. I'm going to brag a little bit about John. I mean, he has his undergraduate from Stanford, went to the University of Michigan Law School. Do you got to be that smart to get in the multifamily business? I know it didn't hurt, but...
Thanks. I don't quite know what to say there. But,
so go ahead.
The one key to all this, it's really just hard work. It's just diligence and staying on top of things and really studying the properties you're trying to buy and really just being just working hard. I mean, I think that's, if there's one secret to success, I'd say that's it. No substitute.
And John and Cross have done a wonderful job with Presidium, and we definitely appreciate John being in the podcast. Again, we appreciate the opportunity to close another one of your transactions for our borrowers. So we appreciate that. James, thanks for being in the podcast. Michael, thanks for being in the podcast also. John Griggs with Presidium, thanks for hanging out with us. I'm Paul Peebles. We'll talk to you next time.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.